so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Getting fucking rich. I want my fucking money. Griffin, I want my fucking money. Yeah, motherfucker. Holy shit, we're gonna be so fucking rich. Damn it, we're gonna be so fucking rich.
All right, all right. Here we go, welcome. Haha.
Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, cowboy, give me the fucking money. Get the goddamn money printer out.
Boy, it looks like mutual funds are crashing.
Great.
And meme stocks, well, you'll see.
The bounty cutter.
We're gonna be so fucking rich. Get the goddamn money printer out.
All right, ladies and gentlemen, welcome to Boss Blunt's Think Tank. Here we go. You guys ready? The SOFR rate has spiked. It looks as if the secured overnight financing rate is indicating that mutual funds, money market funds, are on the verge of a collapse, just like we saw in September of 2019. Specifically, September 16th of 2019, money market funds began to crash. The majority of people out there don't even know that this occurred. And the federal government, the United States Treasury, had to come out with a little something called the scamdemic in order to, well, print a shitload of money and save the stock market. Let's put it that way. But right now the SOFR rate has spiked to a new all-time high of over 5.4%. Let's take a look at that right now. Here you go, ladies and gentlemen. Strap in. This is going to be a short one. 10-minute stream, tops. 10 minutes. So bear with me. Watch this. SOFR rate spiked to 5.4%, which is matching an all-time high. During increased borrowing costs are very, very likely to occur. So as SOFR took over for the LIBOR rate, the London Interbank operating rate, and the cost of borrowing funds for hedge funds, prime brokerages, you name it, to maintain their short positions has increased. Short sellers need to borrow shares to sell them short, and higher interest rates through the SOFR rate spike, as we're currently seeing, makes this even more expensive. Margin calls are even more likely to happen, which could be a possibility of what we're seeing with costs. Because this was a massive run. At some point it was up 250%, ended up the day around 143%, and is currently up around 20%, even in the after hours on top of that. So higher borrowing costs lead to margin calls for those who are heavily leveraged. If short sellers cannot meet those margin calls, they might be forced to buy back the shares they borrowed. This further indicates a tightening of liquidity, which means it's harder to get cash, all right, in the financial markets. This makes it harder for short sellers to find the necessary money in order to maintain their short positions. And it leads to increased market volatility as the rising interest rates and borrowing costs occur. So the prices of heavily shorted stocks can easily rise sharply if short sellers rush to cover their positions, leading to a short squeeze. In summary, the rise in SOFR to 5.4% could easily exacerbate market conditions for a short squeeze, without question. Here we go, ladies and gentlemen. Now, let's take a look here. This is the 5.44%, the highest level seen in history, matching the previous all-time highs that we saw in 2023. This is extremely important because it shows, as you can see here, from Heresy Financial, the financial system is beginning to crack again. This isn't the first time. This isn't the second time. This has happened on multiple occasions. This happened on September 16th of 2019, to be specific. Okay? And it was the same exact cause, a lack of liquidity and cash in the financial system. But today, it's from a combination of excess government deficits paired with the quantitative tapering from the Federal Reserve, even though they have backed off on some of the QT and continue QE. Basically, the government is trying to borrow more and more money, while the money printer is doing the opposite of printing, shredding, but still reducing their balance sheet at a slower rate. At some point when this thing runs out of money, as we can see by the reductions in the reverse repurchase program from $2.55 trillion last year to under $450 billion today, this is a big problem for these firms. When this happened on September 16th of 2019, the Fed started quantitative easing again, and they began printing a shitload of money. As you guys then can imagine, that led into what sorts of artificial printing of money. 40% of all funds were created. 40% of all money in existence was created in the 18 months following the scamdemic. This time, they're facing opposition to that because of, one little word, inflation. Inflation is much higher than the current target rate, regardless of what the CPI numbers lead you to believe, because of the changes in the calculation to inflation. And now, this leads us to today. Costs ended the day up 143%. 143%, ladies and gentlemen. GameStop and AMC usually follow or move in conjunction anytime cost has major movements, and vice versa, because they're held in many of the same derivative baskets of stocks held by institutions that are short these stocks. Because of these derivatives, the real number of shorted shares on any of these stocks and other equities in the market is actually unknown, due to the fact that they hide the short interest with the use of ISDA contracts, swaps, futures, contracts for differences, CFDs, collateralized debt obligations, CDOs, tokenized securities, married calls, married puts, divorce calls, divorce puts, rehypothecations, shorts marked as long, the list goes on and on and on. So you can see that the volume here on cost was over 65 million, and their free float is just a touch over 5 million. That's an increase of over 12 times the actual free float that was traded. And you can see that the volume on AMC stock was just over 13 million, and GameStop was just over 11 million. Historically, even for the past month, 3 months, and 6 months, this is greatly, greatly suppressed, artificially so, by high-frequency trading algorithms, Aladdin, BlackRock's famous computerized trading algorithm. And the reason they're so heavily suppressed is, in my humble opinion, because the algorithms that manipulate these stocks can only handle so many buy and sell orders at a time. They are very sophisticated pieces of machinery, very sophisticated, lots of the world's best quants working on them and programming them, but even still they have limitations. And when the stocks like costs are trading 1,200% their entire free float in one day, it shows you that there's a massive issue. And this means that there's either A, almost all shareholders bought and sold all of their shares of costs 12 times, and 12 times today, or B, synthetic shares have been created by the market makers through the use of the market maker exemption rule 203B, which allows them to legally naked short the stock. This is called operational shorting, okay? In order for them to set the price of securities back down to where they believe it should be. You guys have heard Kenneth Cordell Bedpost Griffin say this before. Now, as you guys know, his part of his middle name is now Bedpost because allegedly his wife said during the divorce proceedings that Kenneth Cordell Bedpost Griffin, during an argument when she told him that she wanted a divorce, he actually threw a bedpost at her. So there you have it. And as there are no options, there are no calls or puts available on costs, the market makers are unable to create synthetic long positions. This means they can't buy calls in order to pretend that they're hedged. They actually have to buy the shares of stock. So they cannot create these synthetic longs. They cannot use call contracts in order to marry long calls that have been purchased along with covered calls that have been sold. Therefore, they must buy the shares of stock in order to hedge their positions to be delta neutral, to achieve neutrality. Money at the end of the day, it's all about money. And in 2021, when GameStop and AMC each individually rose over 2,000%, costs rose over 480% to $64 a share. As you can see, about 1/4 as much as the other two stocks. Not in a dollar perspective, but in a percentage perspective. All three of these stocks, AMC, GameStop, COS, and about a dozen others, including the ETF SLV, which is also heavily shorted, were forced into sell-only status. This means that they were position close only by brokerages like Interactive Broker, Robinhood, Webull, amongst many others, due to the clearinghouses, such as Apex Clearing, being unable to offer them anymore without their complete insolvency. Same as Robinhood. They had over a $2.5 billion margin call. Of that, around 2/3 of that was attributable to their positions in AMC, and about 1/3 was attributable to GameStop. So even though the GameStop dollar amount was significantly higher than AMC, both of them were up around 2,000%. And because AMC has a lower current dollar amount and more actual retail shareholders currently holding the stock, and at this time a smaller float, excuse me, I believe both of them have incredible potential to see new all-time highs, and I believe that they will. However, I'm not a financial advisor. It's not financial advice. Do your own due diligence. Hire your own financial advisor. However, I do believe that AMC stock, on a percentage standpoint, not in a dollar amount, but in a percentage standpoint, will achieve greater overall percentage gains than GameStop. And both of them will greatly exceed the percentage gains of costs. Though that's just my opinion from the due diligence that I've done over the last 3 years, which exceeds over 6,200 hours of due diligence just on these stocks. These brokerages like Robinhood and Webull, IBKR, etc., literally robbed retail investors of billions of fucking dollars. They fucking robbed you. They stole from you, period. Along with the market makers, the clearinghouses, and the prime brokerages that were involved in these. Now, retail investors have learned with great context and confidence how they can beat the short hedge funds at their own game. Okay, this is what happened to Archegos, to Bill Huang, to Credit Suisse, because as Archegos collapsed, as other hedge funds collapsed, family offices collapsed, prime brokerages have to take over those risks, and the incredible number of CFDs, CDOs, swaps, contracts, futures, and so on. So Credit Suisse then collapsed from the over-leveraged positions that Archegos had taken. Now, UBS is left holding that bag of legacy costs, and all of those swaps have not yet been closed out. So along with many of dozens of other institutions that have already gone bankrupt due to their over-leveraged greed, in which they illegally naked shorted and colluded with market makers to illegally naked short these stocks and even remove retail investors' ability to buy them. And to this day, hundreds of funds, hedge funds, family offices, prime brokerages, etc., are at great risk because many of them remain highly over-leveraged. And these pieces of shit are playing a dangerous game of hidden short interest through the use of these swaps and derivatives versus retail investors that have learned how to play the game. Cheers, my friends. We're going to be so fucking rich. And if buying and holding, let me start over. If buying and holding like Warren Buffett breaks the financial system, then maybe the system was already broken to begin with. Now that being said, you can see cost was up big time. AMC was even in the green today, over $5, even though it's almost on zero volume. GameStop was up on zero volume. not zero, you know what I mean, but almost no volume. So here you go. You guys can take a look at my screen right now. This is what I see when I am handling the actual streaming side of it. And so some of you guys can see here, Rand Steve, Crypto Fem Diaz, thank you guys very much. You guys are telling me about all this information. Just so you guys know, if you're with Robinhood literally automatically turns on share lending on your account. You have to go in and manually turn off share lending. And many people have specifically told me that their share lending was automatically turned back on. That's it, ladies and gentlemen. I'm Boss Blunts, the Butcher of Wall Street. That's all I'm going to touch on today because I don't want to overwhelm you with data. But I think right now you've gotten enough data to give this stupid ass stream a like and subscribe if you want to learn more, because I got so much more coming your way. You guys don't even know. I appreciate you all, you guys, for being here. Cheers, motherfuckers. We're going to be filthy fucking rich.